Welcome to the Legally Ever After Real Estate Podcast, where we help you build, protect, and pass on your assets. I'm your host, estate planning attorney Pamela Moss-Garrett. Let's get started. All right. Today we have Caleb Collier. We are going to be talking about wealth management for real estate investors. Welcome, Caleb.
Hey, thanks for having me, Pam. I'm happy to be here.
I'm so excited you're here. And I know when you work with real estate investors, you see specific challenges as a wealth manager when it comes to leveraging capital. Can you discuss kind of some of those challenges and tips you have?
Yeah, great question. Yeah, our real estate families, over the past few years, the most successful ones, I see them running into some of the similar problems. They're successful in real estate investing, which means they're making great purchases, they're, buying and they're selling. And if they're having success with it, what tends to happen is they start to accumulate a lot of capital that, some of them refer to it as dry powder. But that's, in their mind, it's like, hey, for the next deal. And over time, the most successful families start to accumulate a lot of it. And, in the past, when interest rates were very low, this was always an issue as a wealth manager. But now, one of the things I've been sharing with all my wealth management clients is there's tremendous interest opportunities out there for savers. And so there are some unique strategies we can use to help them capture the opportunity cost of that, working capital that they're accumulating with their real estate business while they're not using it. And so it's been really, really impactful and overall enhances their overall entire portfolio.
I love that. And so we're kind of talking about for real estate investors, they want to accumulate that capital because they need it to continue to invest. But can they still get access to it and also have it be growing? And it sounds like from your perspective, the answer is yes. And what are some of those tools? What are some of those recommendations?
Yeah. So absolutely. And I think one other thing I'll say about why it's kind of tended to occur is, I think the real estate market goes through cycles, and a lot of the ones I'm talking with, my clients are saying, yeah, we're having some success. We're exiting some properties, but we don't see a lot of great opportunities out there. So then they start accumulating more cash. But to your question, there absolutely are strategies and tools out there where they can accumulate that capital. They can have it earning interest for them, significant interest. And it can be accessible to them when they need it. So one of the most effective tools that we've seen is a properly structured life insurance contract. As a wealth manager, I'm a big believer in leverage. And so one way you create leverage is by accomplishing, a couple goals with the same tool. Most of my real estate families need life insurance, whether it be for estate planning tax purposes, or family purposes, even income replacement. So they need life insurance. And then we take that need and we combine it with the fact that they have large amounts of capital that they are holding at any one time. It can flow in, it can flow out. And so we've set up what's called a properly structured life insurance contract, where we can have those funds there with a large, highly rated insurance carrier. While the family's not using them, those funds are accumulating interest. They're doing it on a tax deferred basis. So each year we're not getting a tax bill for the interest that's accruing there. And then as they need it, maybe there's a deal that they want to go enter into and purchase a piece of real estate, they can borrow against their own funds, borrow the money out. There's some really unique strategies where some of that money on the borrowed funds could actually still be earning interest according to, the way the contract's established. Or if they just want to do a pure loan, they can do that. It's a loan on their own money. So if there was any interest that they'd pay, they'd be paying it to themselves. And then the neatest part is at the end of it, again, leverage, as they start to transition possibly into a retirement, whatever's accumulated in there, they can borrow out, and they borrow it tax-free. So, life insurance is really unique, Pam, and there's really only 3 places in this country we can grow assets tax-free. 401 Roth accounts, Roth IRAs, Roth 401ks, municipal bonds, and a permanent life insurance contract. So for our highest net worth families, many of them who are real estate families, they can earn this interest tax deferred and access it tax free. And it's very, very flexible. And what they've found, I have one family that is earning nearly as much interest with their dry powder as they are with their entire real estate portfolio right now. So it really enhances that. And it starts to get that real estate investor to see too, that there could be another, they've been so used to their cash flows coming from their real estate practice. Now, or the real estate portfolio, now it's coming from another place. They have this second, income stream that's reliable, and it really helps them to see a future retirement.
I love that, Caleb. And one of the things that I really appreciate about your approach is I feel like there are kind of in the real estate investor community, there's kind of this nervousness around talking to wealth managers. And there are wealth managers that really just don't understand real estate investors. And you work with a lot of real estate investors and you're real estate investor friendly. So
Yeah.
you understand that they want to still invest in real estate and they want to diversify, but there's also tools that they can use to their advantage. And one of them is kind of these life insurance policies. So, for people that are listening who get those calls about buying life insurance, a lot of us get inundated. What are the things that they should be keeping an eye on? Obviously this isn't a product that they should just go and buy online. There's some dangers, right? There's some things that they should watch out for. What are the things that they should really be looking for so that they can find the right product that you're describing here?
Yeah. Awesome question. And super important too, because, life insurance as an investment, as a place to store value and to earn interest, it has to be set up properly. And back to your one point about our firm being real estate investor friendly, when I meet with my real estate investor families for first visits, I get to learn about them. They obviously have a lot of success and they've created a lot of value in the success through their real estate practice. And I'm not going to sit here and tell them that I would be more successful investing their money, and get out of real estate. I want them to continue to do what they enjoy doing. We're just looking for ways to enhance what they're already doing. And that's why, this move of getting some of that working capital earning interest while it's sitting there is such like I said, a leverage point for their overall practice. If you're looking for someone that can do it right, for one, and this kind of relates to even looking for wealth managers, I always say, you probably should talk to a few of them. I'd look for one that can do it all, someone that is a fiduciary. In our practice, our advisors are fiduciary. So we have that high fiduciary standard. Look for one that, isn't just selling insurance, because the way that you properly structure these contracts is you really minimize the life insurance aspect to make sure that the cash is growing at the most effective rate. And so most insurance salesmen are looking to sell more insurance. That means that your cash is going to grow slower and they're going to make more money selling you more insurance. Insurance is important in these sales. I want families that need insurance, but it's not the main reason, or it's certainly not the only reason that we're using a tool like this. And so I think finding a fiduciary, someone, the last level is kind of someone that's independent. If you find I won't name any names, but if you find a captive insurance agent that works for one company, they're going to offer you their product. And so one of the advantages we have in our firm over others is we're independent. So I represent 30 or 40 different life insurance carriers out there. We go find the absolute best one for our clients and their needs. And that combined with our fiduciary standard and really, 25, 30 years in business and doing things right for clients really, really helps. So I think those are some keys: fiduciaries, independent if possible, and someone that does more than just life insurance.
That's super helpful. And one of the things from a life insurance perspective that you mentioned that I just wanted to talk about is, a lot of times you mentioned kind of the tax input and the tax impact, and that being a tax minimization strategy. And one of the mistakes that I see people doing is they purchase these policies in their own name, and then they're getting a higher estate tax hit when they pass away. And so setting up irrevocable life insurance trust ahead of time, having that trust set it up, is that something that you kind of see your clients doing as well, working with an estate planning?
Yeah, that's why we love working with your firm, Pam, is understanding you can do something, like you said, you can do something good on one aspect. Let's get working capital better, but we would never want to create a bigger estate tax issue by creating a large multi-million-dollar death benefit that now is also going to be taxed through the estate. So that's why, I always tell our clients wealth management is three parts. It's investment consulting, It's advanced planning, which is kind of what we're talking about here. But the last part is relationship management. And that relationship is why we work together well. We need that estate planning aspect. We need to understand the impacts of estate planning. So, thinking ahead, having your own, buy an ILET trust, possibly inside of, other assets inside of, spousal lifetime access trust or other trusts we might use to keep these assets out of the estate, to minimize estate taxes, but give them the ability to have choice and control still is really, really important.
And then the other thing that you said that is, I think, really helpful about life insurance as a tactic, as a tool, is a lot of my real estate investors come to me concerned about asset protection. They're worried about litigation. They're worried about assets getting taken. And that's one of the benefits as well of moving some of that capital out of your personal name into an insurance product that wouldn't be able to be accessible in a lawsuit. So that's another key point there.
Yeah, most people don't realize that. I mean, it's a great point you bring up, Pam. And I think you can do multiple layers of that, right? Life insurance, cash value for a husband and wife. If you have a husband and the wife's the beneficiary, there's a lot of creditor protection in that. Combine that with trust that could then own that. I mean, you can build a lot of walls around your wealth to protect it from those type of risks.
And then kind of moving into kind of another component of what you do is really succession planning. And from a real estate investor perspective, what do investors need to know? What challenges have you seen when it comes to succession planning?
Yeah. So, I was mentioning earlier, one step in it is to start to do some of this advanced planning around some of the concepts we've already discussed. I found that some of my real estate families are so used to their entire income's coming from real estate, and it's been very good. But when they start to think about succession planning, transitioning to a retirement, selling the business, if they don't have a natural succession within the family, which sometimes works out, sometimes doesn't, they start to wonder, well, how am I going to transition to, getting out of this? They think about the tax implications. So even getting started early and saying, oh, I can build this separate use this separate tool to give me another stream of income that I could retire on, starts to get their mind working that way. But what still lingers, Pam, is the tax questions, because they're thinking, hey, we have all this real estate. There's a lot of, long-term capital gains sitting in these assets. And they understand that if they keep holding on to them and wait until they leave them to the next generation. Right now, we have the step up in basis, so their families wouldn't be subject to that long-term capital gains tax. What many of the families don't realize is there's actually a way for them to go from this active management, where they're actively managing these properties, to more passive real estate investing. And really not much changes. And I've seen this, Pam, from I've seen them go, some people who thought they were doing pretty well with their overall portfolio, be able to transition to this passive style, which is basically we use 1031 exchanges. So we're going to exchange into properties, but properties now that they're not going to manage. We're going to exchange it with sponsors who've been managing properties for 20, 30 years. We can now diversify their portfolio. I'm sitting here in Detroit today, have a family that has a lot of real estate right here in Detroit. But imagine that family now, 1031 exchanging some of that value into properties in Phoenix and in Orlando and in Nashville and different places around the country. Now they've diversified their portfolio. And for some of them, I've seen their income actually increase. So the same amount of value that they were personally working to, drive that income and to manage those properties, now they are actually making more net income letting someone else manage it. And usually what's nice to do is start to do that progressively as they near retirement, and they start to see, wow, we moved this one property into, a passive situation, using direct real estate investing, but letting someone else do the work. And they start to see this way out, and it's really important too for those families, even the ones that are doing really well and having a high income off of their real estate portfolio. If they don't have like a natural succession, either with a family member, a child, or a really trusted, person that works in their firm, they start to worry, well, how am I going to get out of this? And so this is a way for them to maintain the value, maintain the tax status, but potentially increase their income or keep it about the same, but not have to do the work.
And some of those kind of passive strategies, you've mentioned funds. I know there's syndication. What are some of the things that you're seeing that are good things for your clients to look into to go more passively?
Yeah, well, there's a huge range. There's a range from very fractional shares through REITs, real estate investment trusts, obviously different syndications of REITs. You have what are called DSTs, Delaware Statutory Trust. Those are also fractional 1031s. They have a sponsor. You can move, certain amounts of assets and they can help with the 1031 exchange. Our most successful families look to we call direct real estate investment, where they're doing a 1031 with a sponsor. And, they could be selling, let's say a $10 million property here in Detroit, and they could go into 5 properties throughout the country with that sponsor, different fractional shares of those properties. Typically the more direct it is, the less hands are in the pot. We utilize some other professionals in our world that are experts in those areas that we bring our clients to. But I found that the more direct it is, the less packaged it is, the less syndicated it is, the more opportunity there is for our clients. And that's why on those direct real estate deals, we're seeing really, really good preferred incomes, really, really good promotes, that are getting passed down to the investor family. Where, like I said, at the end of the day, they're saying, hey, for that same value that I was managing myself, now I'm making more net income. That's the other part of it too. I guess I should mention for any of your clients that are in highly appreciated areas, that's another problem that they're running into, is that their rents can't keep up with the value as it's risen, but they're looking at their market. You think of you in Denver there, they're looking at their market and thinking, if I sell something here, I got to go buy something, and do the 1031 exchange, and there's just not enough value out there, and I don't see it. Well, now they could, use a fractional DST or a direct real estate investment. And now they sell that full value. They go into 2 or 3 or 4 different properties around the country. And now they're leveraged again, fully leveraged. Maybe they get to like a 70-30 leverage or something like that. So now there's more, depreciation for them. Their income's more tax-free. So there's a lot of potential benefits to doing that. And like I said, depending on the family's net worth and the amount of real estate that there is, you can really get up into those direct real estate investments, which are going to be more similar to what they've experienced doing it on their own.
It sounds counterintuitive, right? So they're less involved, but they're making more money. And it's kind of one of those things that people want to hang on to, but then they make that transition and it's better. It's better for everyone. It's better from a succession planning, from their effort, from a diversification. Is there any other tips from a wealth manager perspective that you have or mistakes that you've seen when it comes to real estate investors?
Yeah, I think some of the things we've talked about, like I said, keeping an eye on that working capital. It's just amazing how quickly it can accumulate. You buy this deal, sell this deal, refinance this one, all of a sudden cash starts to accumulate. I think the first risk is, they don't view it as a problem, for one, because they think of it like, hey, the money's there if we need to go get it. But there's this invisible force called opportunity cost. And I always tell my clients, if you got a bill for it every month, you'd pay attention to it. The amount of interest you could have earned on that money sitting in cash, if it's in any of the big banks, it's earning, 5 basis points, 0.05%. And really it's costing you opportunity costs. It's interest that you should have earned. And so keeping an eye on that. I think the other part is, not considering all the aspects from a tax standpoint, not bringing in, a wealth manager, an estate planner like yourself to understand how should we be owning these things. My encouragement to any of your listeners who are, a lot of people come to us, and I think you'll relate, they come to us towards the end of their careers, and a lot of the mistakes, if you will, are hard to unwind at that point because there's so much value there. They're over the, estate tax exemption gifting limits, that they're so if you're younger, do it now. Start with those smaller amounts. It's easy to get them owned properly. You can still have control of them. And that's where a firm like yours could come in and help them understand the best way to own these things from a liability standpoint, but also from an estate tax standpoint down the road. I think too many real estate investors don't think about estate taxes until there's an estate tax problem. And really, I think you would agree, with pre-planning, there's no harm in pre-planning, and you can get it done. And then when you grow into that estate tax, value range, you're already protected, So I think that's something that too many people forget about. And they start to worry about not that it's too late, but the problem is there and it takes a little bit to unwind it.
Yeah, absolutely. And I think lately I've had a lot of investors come to me who their parents have passed away and their parents didn't put a plan in place. And so they're paying a ton in taxes. And they're like, okay, I don't want to have my children go through what I've had to go through. And it's hard. So for those listening, you may be in the spot right now to put something in place for your family. But if your parents are still alive, I have a lot of my clients who, and I'm sure you have the same thing, it's a good time to start those conversations to get them to get a plan. And I feel like, I don't know what you've seen kind of the generations right now, but I think they're a little bit more open to putting plans in place, especially when their kids come to them and say, hey, I've put together a plan, let's do it.
Yeah.
But the silent generation is kind of phasing out, but
I agree with you. And I mean, maybe you can speak to this a little bit, but I feel like I've been in this business 20 years and working with estate planners. I feel like the tools that you have available now to help these families deal with some of these issues are more flexible than they ever were before.
Yeah.
When I first got in the industry, I mean, there was revocable living trusts and irrevocable trusts. And it was like, you can touch it, revocable trust, you can never touch it again, irrevocable trust. And it just seemed scary. And so people weren't willing to do the planning. But I think a lot more is available now is what we're seeing with working with your firm and others in our area.
You were talking kind of at the top of our conversation about rising interest rates. And obviously we have inflation going up. The stock market is changing. A lot of people feel like this is a really great time for investors. What is your take? What are you seeing as a wealth manager that you would say to investors right now, given the current market conditions?
Yeah. I think interest rate, I mean, a lot of the news is very negative about interest rates. And I think I think about how it applies to a real estate investor. The fact is when interest rates rise, the cost to borrow money is higher. And so, if you're sitting on a bunch of cash, you're probably feeling very good because, what should happen is the real estate market should cool down a little bit, which means there might be better opportunities out there. But again, going back to that working capital part, the flip side is for people that have saved a lot of value and have savings, have a lot of working capital, the interest opportunities now have increased 200, 300, 400% for safe investments that don't have principal risk. I can, you see these online savings accounts. I have one that's paying me 3% right now, on a FDIC insured savings account. Go back a year ago, that was, 0.5%. So, that's a 600% increase. And so I think there's, interest rates are something that needs to be understood and they can be taken advantage of. If you're borrowing, yes, the cost is higher, but now when we're investing, the opportunity is higher. And so they typically work hand in hand. You need to be taking advantage of both sides of it is what I would say. Don't just sit, on your hands and say, oh, it's the cost to borrow is too high. There's nothing to do right now. Well, if you invest at that same rate in a compounding interest rate environment, you're not worried about the simple interest higher cost right now. So I think you really got to take advantage of it.
That's super helpful. So Caleb, for people that are listening that want to get in touch with you, what is the best way for them to reach out to you?
Well, of course. Yeah. Well, we have a great relationship with Law Mother's office. So if you want to reach out directly to Law Mother and say you'd like to have a conversation with our firm, Collier Financial is the name of our family firm. Maripol Wealth Management is our RIA. You can email me at caleb@collierfinancial.com. Also, our direct number is 734-389-7575. Would love to have a conversation to see if there's a way we can enhance what our real estate investors are doing and make their make their business more profitable and more enjoyable.
Wonderful. And I'll include all that information in the show notes. My final question that I ask everyone, Caleb, is what is your legacy?
Well, I'm working on it. But my legacy is no matter what I'm doing in life, my mother and father taught me to just always leave things better than when we found them. So whether it's in business, whether it's in personal relationships, whether it's with our three children, my wife and I's three children, we just want to continue to leave things better than we found them, help, see if we can improve, and enjoy those relationships. So that's my legacy.
I love that. Well, thank you so much, Caleb.
Thank you, Pam. Appreciate it. Have a great day.
You too. If you need an updated will, trust, or estate plan, and you are a Colorado resident, we would love to be your estate planning law firm. Give us a call at 720-706-0036 to schedule your complimentary 15-minute call. You can also directly schedule at lawmother.com/go. If you liked this episode and you want to learn more, you should definitely check out my international best-selling book, Legally Ever After. It's available on Amazon as both an ebook, a paperback, and an audio version. And if you'd like a free chapter, head over to lawmother.com/LEA.